Have you ever wondered if there was a smarter way to earn from your investments, even when markets fluctuate? What if you could harness the power of market volatility to generate a steady stream of income? Well, if this is your goal, then you need high-yield dividend ETFs, where strategies like covered calls open the door to potential gains through consistent, scheduled payouts. These ETFs aren't just about returns, they're about smarter, more strategic investing in both stable and volatile conditions. From capturing the bustling energy of the Nasdaq to the innovative applications of Bitcoin, these funds are reshaping the landscape of investment income. So, join us as we delve into the mechanics, benefits, and considerations of ETFs like XDTE, QDTE, and YBTC, exploring how they manage to provide investors with regular dividends in a way traditional assets might not. So, without much ado, let's get started. Analysis of individual ETFs. Exchange-traded funds have become a cornerstone in the investment portfolios of many due to their diverse strategies and the broad array of market segments they cover. These funds, known for their cost-effectiveness, transparency, and liquidity, offer investors an efficient way to gain exposure to different investment strategies, ranging from conservative income-focused funds to aggressive growth-oriented strategies. Within this spectrum, high-yield dividend ETFs occupy a special niche, catering to those seeking consistent, higher-than-average income distributions. ETF strategies vary significantly based on the underlying assets they target and the methods they employ to generate returns. Traditional ETFs typically track a market index and are used primarily for passive investment strategies. For example, a standard S&P 500 ETF aims to mirror the performance of the S&P 500 index by holding a basket of stocks that replicate the index. On the other end of the strategy spectrum are actively managed ETFs, where portfolio managers make specific investment decisions with the aim of outperforming a benchmark index. These actively managed ETFs may target high-growth sectors, employing dynamic trading strategies, or use option strategies such as covered calls to generate additional income. The covered call strategy involves holding a position in an underlying asset while selling call options on the same asset. The objective here is to earn the option premium as an additional income source, which can significantly enhance the yield, especially in a flat or moderately rising market. However, this strategy can cap the upside potential of the ETF holdings since the seller of the call is obliged to deliver the underlying stock at the strike price if the option is exercised. So now, let's delve deeper into the high-yield dividends that use this strategy, starting with the S&P 500 Zero-Day to Expiration ETF, XDTE, the Nasdaq 100 Zero-Day to Expiration ETF, QDTE, and the Bitcoin Covered Call Strategy ETF, YBTC. Each of these ETFs employs a nuanced variation of the covered call strategy tailored to their specific market segments. XDTE S&P 500 Zero-Day to Expiration ETF. This ETF presents a unique investment opportunity for those interested in capitalizing on the efficiencies of the options market while maintaining exposure to the broad stock market. It leverages a sophisticated strategy focused on covered calls, which has garnered attention for its innovative approach to generating income. In deep, it specifically targets the S&P 500 index, one of the most widely recognized benchmarks for U.S. equity performance. This ETF strategy involves writing covered call options on the S&P 500 with a very short lifespan, 0 days to expiration. This means that the options expire on the day they are issued. This strategy capitalizes on the intrinsic time value of options, which erodes as the expiration time approaches and completes when the market closes. If the S&P 500 ends the day below the strike price of the call options, the ETF retains the full premium received from selling the options, which is then distributed to shareholders as dividends. The expected yield from XDTE is an attractive aspect, particularly for income-focused investors. By engaging in daily options trading, the ETF aims to generate consistent, potentially high yields derived from the premiums collected on the expiring options. The yield is not fixed and can vary based on market volatility. The more volatile the market, the higher the potential premium income. Estimates suggest that the annualized yield could range between 25% to 40%, depending on market conditions. This high yield potential is particularly compelling in environments where the traditional fixed income investments might offer lower returns. As a relatively new entrant in the ETF space, XDTE began with a modest amount of assets under management, totaling around $1.3 million initially. However, the unique strategy and the lure of high yields have the potential to attract more investments as the ETF demonstrates its capability to manage the risks associated with its aggressive strategy. The market performance of XDTE will largely depend on its ability to effectively execute its covered call strategy and the behavior of the S&P 500. Given the ETF's short existence, initial fluctuations in market value and assets under management are expected as it finds its footing. So, investors must weigh these risks against potential for high income in a low interest rate environment, where traditional income-generating investments might not provide sufficient yields. QDTE NASDAQ 100 Zero-Day to Expiration ETF. Now, this is another innovative investment tool that aligns with the modern investor's quest for high yield in a low interest rate environment. It stands out by employing a covered call strategy that capitalizes on the inherent volatility of the NASDAQ 100 index, offering potential for considerable income through sophisticated financial techniques. Simply, you can call it an index that comprises 100 of the largest non-financial companies listed on the NASDAQ stock market and is heavily weighted towards technology stocks. This tech-heavy composition is pivotal, as it inherently includes a higher degree of volatility compared to broader market indices, such as the S&P 500, which the XDTE ETF targets. The unique character of the NASDAQ 100 not only defines the risk profile of the XDTE, but also enhances its potential for yielding sufficient returns through the zero-day to expiration covered call strategy. While QDTE shares a similar underlying strategy with XDTE, which is the execution of zero-day to expiration covered calls, there are key differences driven primarily by the nature of their respective indices. The NASDAQ 100's volatility provides richer premiums on the options sold due to higher fluctuations in stock prices. This generally translates to potentially higher yields for QDTE compared to XDTE. The frequent peaks and troughs in tech stock prices allow QDTE to capitalize on the sharper premium decay just before the options expire, which is less pronounced in the more stable S&P 500 index targeted by XDTE. Since its inception, QDTE has shown a promising start, reflective of investor interest in alternative income sources and the tech sector's appeal. With initial assets under management amounting to approximately $9.1 million, it has quickly attracted attention from both retail and institutional investors. Investors considering QDTE must weigh the higher volatility and potential higher yield against their personal risk tolerance and investment goals. The heightened volatility of the NASDAQ 100 can lead to both substantial gains and losses, particularly in a strategy that involves frequent trading of options. This ETF is best suited for those who are comfortable with significant market fluctuations and who have a thorough understanding of option strategies. Moreover, the potential for a higher yield through options premiums must be balanced with the risk of capping gains if the Nasdaq 100 experiences a sharp upward trajectory. In such cases, the ETF may have to sell its holdings at the strike price, potentially missing out on significant capital gains. So while the high income potential is attractive, it comes with the trade-off of potentially reduced participation in the growth of the underlying assets. YBTC Bitcoin Covered Call Strategy ETF. Now, this one represents a unique convergence of traditional finance strategies with the burgeoning field of cryptocurrency. This ETF stands out not only for its focus on Bitcoin, a leading digital currency, but also for its application of a classic options trading strategy, the covered call, to this highly volatile asset. The incorporation of such a strategy in the realm of digital assets underscores a significant evolution in how investors can engage with cryptocurrencies in a regulated and more traditional investment framework. YBTC offers investors a structured approach to gaining exposure to Bitcoin's price movements while potentially generating income through the options market. Unlike typical cryptocurrency investments that require buying and holding digital coins, YBTC employs a covered call strategy which aims to yield returns not only from the asset's appreciation, but also from the premiums collected on the sold call options. This method introduces a traditional stock market strategy to the cryptocurrency world, providing an innovative tool to investors who might be looking for ways to integrate Bitcoin into their diversified portfolios without dealing with the complexities of direct cryptocurrency ownership and management. The covered call strategy involves holding an underlying asset like Bitcoin or Bitcoin-related securities and selling call options on the same asset. For YBTC, the strategy is to sell options that have a higher strike price than the current market price of Bitcoin. This allows the ETF to earn a premium from the option sale, which is paid upfront by the option buyer. If Bitcoin's price remains below the strike price at expiration, the ETF retains the premium and the Bitcoin. However, if the price exceeds the strike price, the ETF might have to sell the Bitcoin at the predetermined price, capping the upside potential but still realizing the premium and any capital gains up to the strike price. One of the most attractive features of YBTC is its distribution yield, notably high during the inherent volatility of Bitcoin, which boasts the premiums that can be charged for the options. The ETF has set a precedent with its monthly payouts, which are distributed from the income generated through the sold call option. Given the high volatility, the premiums, and consequently the yields are substantial, making YBTC an appealing option for income-seeking investors. This high yield, however, is accompanied by the typical volatility risks of Bitcoin, which can affect the amount and stability of monthly distributions. Bitcoin's price volatility significantly impacts the performance and appeal of YBTC. High volatility increases the potential premium that can be obtained from selling covered calls, which may lead to higher distribution yields. On the flip side, this same volatility can lead to considerable price fluctuations in the ETF's net asset value, as the underlying asset, Bitcoin, can experience sharp increases and decreases in value over short periods. This aspect of Bitcoin's market behavior requires investors to be particularly cognizant of timing and market trends when investing in YBTC. Since its launch, YBTC has managed to capture the interest of both cryptocurrency enthusiasts and traditional investors, evidenced by its growing assets under management. Starting with significant initial assets, the ETF has navigated the cryptocurrency market's ups and downs, reflecting the broader trends in Bitcoin's market value. Performance-wise, while YBTC offers the potential for high returns through option premiums, the returns on the underlying Bitcoin investment can vary widely with market conditions. The appeal of receiving more frequent dividends through sophisticated strategies that harness market volatility offers a compelling narrative for the modern investor. However, these benefits come with their own set of risks, necessitating a balanced and informed investment approach. As markets evolve and investors' preferences shift, these ETFs may continue to play a significant role in the portfolios of those seeking to diversify their income sources and manage risks associated with traditional equity and fixed income investments. So now, how do you feel about these innovative ETFs? Intrigued by the idea of high-yield dividends? Let us know in the comments. Don't forget to like this video and subscribe to our channel for more insightful content like this. Until our next exploration, happy investing!